What is actually going to matter in 2026 and what is just noise? That is the question I'm answering today. Welcome to another episode of Equity Mates, a show that helps you explore what is possible in the world of investing. My name is Ren, and today I am once again solo as Bryce takes a well-deserved break. But I've got an exciting episode for you. I'm joined by Seb Mullins. He's the head of multi-asset and fixed income at Schroders in Australia. And together we're going to unpack what matters and what perhaps won't matter in 2026. And it's a good time for you to have this conversation because we're just getting to that point in the year where we're seeing predictions for the year ahead. There's a whole cottage industry of analysts and experts that make predictions for the year ahead. Which themes will be big, which will fall off, what countries to invest in, which ones to avoid, the hottest stocks for the year ahead. It's a well-trodden path, we see it all the time. But this year, perhaps more than other years, you could really make an argument for either direction. If you want to argue the Australian economy is going to go well, you could point to things like consumer confidence hitting a 4-year high. If you want to argue that the Australian economy is going to go poorly, you could look at our rising inflation number, which is at the top of the RBA band and may tick above it. The challenge for investors, for all of us, is to separate the signal from the noise. Try and understand what will matter and what is important, and then understand what we can safely ignore. So that is what I wanted to unpack with Seb today. Before we get into the episode, I want to say a massive thank you to Schroders for sponsoring this episode and helping us keep all of our content here at Equity Mates free. All right, well, with that said, let's get to my conversation with Seb Mullins, head of multi-asset and fixed income at Schroders Australia. Well, Seb, welcome back to Equity Mates.
Thanks for having me, Ren.
So we've got a lot to cover this episode. We want to talk about your outlook for 2026. But before then, I want to go back to when you last joined us in March of this year. Mm-hmm. Now, one of the big takeaways from that conversation was you called the return of volatility. And that was before Liberation Day. So well done. You called it, or you knew something. I guess from there to here, how would you wrap up the year that was? What were the key things that you were watching and the key insights we can draw from it? Sure,
thanks, Ren. Yeah, I think it's been a roller coaster ride, as you can remember, with Liberation Day onwards. Like, it was a recession that was coming for about a few weeks and then it dissipated again. But I think a lot of the things we talked about in the last episode was talking about how volatility is back, and it's not just 1 year or one president, it's a new shift in regime. And the reason we're saying it back then, and we're saying it a few years ago, was literally you've had a period where most governments weren't spending money. So think about after GFC, you had Tea Party in America, you had austerity in Europe, whereas now governments are required to spend. Now we can debate whether it's spent correctly or not, but if you think about defense spending, like in Germany right now, for example, even security of critical minerals, that's come up this year. That wasn't a conversation last year. A few years ago, we had COVID issues, et cetera. So there's money to be spent on supply, on defense, on inequality, entitlement spending. All these things require governments to spend now. So it's a 180-degree turn from having monetary policy that lifted all boats to fiscal policy that dominates where money flows. So the invisible hand of Adam Smith is now a very visible hand of Donald Trump saying, put money here, put money there, right? So in a way, we've had more checks in the checklist this year. So think about government intervention. You've had the US buy stakes in Intel, MP Materials, the new nuclear renaissance. Like, this is government-directed spending and investment, and that sort of crowds out the private sector somewhat. We talked about beware lack of central bank independence. You had Kruger resign somehow, I don't know how, but she left. They put Moran on the board, who's more dovish. He tried to fire Lisa Cook. He's always trying to fire Powell. Like, central bank independence is wobbling. And I think another one that was interesting is we talked about inflation being defended by central banks hiking rates, but if they ever put more pressure or more emphasis on their labor goal over their inflation goal, that would be a turning point. And of course, they're cutting rates now with inflation at 3%. We haven't got down to 2 in over 5 years now, so they're showing their hand there. So I do think we're entering this more inflationary dynamic, and it's here to stay. But I think that taking back from all that Trump news, more broadly, we discussed that it'll be the continuation of U.S. exceptionalism. That has continued this year.
Yeah, it has.
U.S. economy going gangbusters despite all the recent wobbles. Equity markets, AI continues to rally hard. We discussed the rest of the world playing catch-up. That's kind of happened. Economically, they have improved. equity markets have rallied, but it's still been a US exceptionalism story this year.
So of all of that and of everything else that happened this year, was there any big surprises for you, either in the data or maybe in investor behavior?
Good question. So lots of surprises. I mean, I think we thought Trump was going to be as aggressive on tariffs, but the one that surprised me the most was probably looking at positioning and retail positioning in particular. Because in a way, what was interesting is leading into, post-election 2024, positioning was stretched max long. Exuberance, everyone priced in the positive of Trump and forgot the negative, which we discussed last time. But when Liberation Day came, everyone sold except for retail. They bought hard. And the positioning we look at, it was like 1.8 standard deviations overbought to 1.9 standard deviations underowned, except for retail, which went to 100% long, like it was 100 percentile long. So they were the smart money, and everyone else was the dumb money in that period.
So, like, what do you put that down to? Like, is this retail investors learning and like internalizing the lesson to buy the dip, or is this just retail investors not watching the markets? Or
well, I mean, Trump did tweet buy the dip, which helps, right? So unfortunately, we were asleep at that point. But so that did help. But I think there was enough cash on the sidelines, and it's kind of telling you how the U.S. consumer or household is sitting. If there's enough money sloshing around that they can buy the dip, that's interesting. If you think about the economy for one point. But the belief that Trump would backflip, like before the taco trade was a thing, I think everyone was waiting for him to backflip. And maybe as an institutional investor, we get caught in our heads too much. But our view at the time was the economy was fine, and Trump would backflip at some point. But the longer it took him to make that call, the more damage would be done in the economy. You know, lack of spending, CapEx stops because you didn't know where to invest, hiring freezes, etc. So we worried about a recession coming if he took too long. But the speed of the taco trade and the ability for retail to jump in was interesting because they were in first and they caught all this rally. Whereas mutual funds or sophisticated investors, whatever you want to call them, they were the last to join in, and they're still sort of underweight at this point in time.
Yeah, that is interesting. I mean, the fact that in March and April, the US consumer was maybe not flush with cash, but had cash that they felt comfortable buying the dip. It would be interesting to see if there's another dip, 2026, how the US consumer is. It appears the US consumer is more stretched. Will they be buying a dip as hard?
Especially if they're already all in.
Yeah, true.
That's the hard part, right? If you're out and you're buying the dip, that's fine. If you're all in max long with levered ETFs, etc., how much money is on the sideline is a question mark. So that is one concern we have. If they're out of ammo, so to speak, that could see weakness, which we're kind of seeing last few days, a few weeks. But ultimately, if the economy stays fine, they're going to keep getting their paycheck and buy the dip.
Yeah. Big if. Well, let's turn to that big if and let's turn to what we can expect next. I know it's always a fraught proposition trying to predict the year ahead, but as you think about 2026, what are some of the headline messages that sort of you want to get across, or like some of the key factors that you're thinking about?
First of all, it's always awkward doing this in November when everything can change. It's even more awkward when the government shut down and we're getting no data right now. Based on our current view, which can change the second it reopens and we get more information, but our current view that's probably less consensus is that the US economy is fine. And if anything, the US economy is going to be quite strong. And the Fed are cutting rates right now to defend the labor market where it might not need help, in which case you have a situation where next year inflation reaccelerates.
Okay.
We're not saying it's a 2022 by any stretch of the imagination. That's when inflation went from 0 to 9%. Probably this 3.5 is the new normal. So higher inflation, higher growth probably means the economy is fine and equities are fine. So our view is probably not too dissimilar from last year, with the US economy is fine and continue to be strong. Rest of the world playing catch up, I think, continues next year. So maybe even more strength in the economy, not relative strength improvement, I should say. The US is going gangbusters and the rest of the world's going from weak to strong, not catching up, but the rate of change is probably better. And there are probably more opportunities now outside the US and outside of AI to make opportunities to invest next year.
Okay.
Unless AI is a bubble, in which case you want to stay in as long as possible and ride that out. So it's that dynamic between assuming everything's normal, then we do think starting to take some chips out of the US to go global is probably the story of next year.
Yeah, okay. Well, let's put a pin in that AI bubble conversation, because we will get to that later. Little tease for later in the conversation. Sticking big picture, sticking with the year ahead, we love a bold prediction here at Equity Mates. Do you have any bold predictions you'd be willing to share with us?
Sure. A bold prediction which isn't our base case, but is increasing in probability is that rather than cutting rates, the Fed has to hike rates next year.
Yeah, okay.
Now, that probably won't happen because the central bank's going to be even more dovish when Powell leaves.
Yeah, Trump will try and fire everyone.
Trump will try and fire everyone. So there's central bank independence question, which is quite important. So that's why I think it's probably not going to happen. But we might be in a situation next year where it should happen.
Do you think about Australia in a similar way, or do you have a view on maybe Australia's next move?
So for us, we think the RBA is done.
Yep.
In terms of cuts, and we're making that call a while ago. The job data is coming out this week in Australia. So after this is released, it'll already be done. But for us, if there's a weakness in the labor market, they'll cut to defend the labor market. And that's, again, defending labor over inflation. But for us, the Australian economy seems to be fine. Seems to be picking up. There's a nice recovery in activity. There's passing the buck in terms of jobs from sort of like, public sector work to private sector work, which is healthy. You're starting to see GDP move up because of consumption. So people like you and me spending our wages on goods and services as opposed to government infrastructure spending, et cetera. So looking pretty healthy. But again, it's recovering from a weak level to a better level. Inflation has appeared to be sticky and growth seems to be improving. So I don't think the RBA is going to cut rates. They won't have to hike rates, but being on pause is probably the right call. Again, all else equal. If unemployment rises dramatically, then that will change our view. But inflation everywhere in the Western world seems to be stickier than expected and growth is holding up better than expected. Whereas in the emerging world, inflation is actually coming down and they can probably cut rates easier. But it's that dynamic between the high inflation EM economies are now improving, whereas the DM world with no inflation is now becoming more inflationary. Yeah,
it's an interesting dynamic. I want to dig into your process because there is so much information out there, and it's all good and well for us to get experts like yourself on and ask for the prediction. But I think there's a lot of value in understanding how you approach making that prediction, how you think about the world, and what really matters. So I guess I want to understand how you separate the signal from the noise. There's a lot of data, and I reckon if I asked you to make any case, you could probably find a data point to back that case up. So
100% correct.
So what indicators matter? How do you separate signal from the noise, and how do you kind of make a coherent narrative out of all that noise?
Sure. Well, I guess the first point is what you mentioned already. We make bold predictions, but ultimately it's running portfolios as our day job. So we can change our mind tomorrow as long as we're making money for our clients. That's our main job, right? These predictions can go awry as data changes. But obviously, Schroders, we're a huge company. We've got different shops doing different things within the business. So I look at multi-asset. So for us, we have our own process here in Australia. So the multi-asset fund, like Grow, for example, ticker GROW on the ASX, like the process we have for that is what we call the VCL framework. So that stands for valuation, cycle, and liquidity. We have like 100 different indicators for each of them, but ultimately valuations are things cheap or expensive. That tells you where the risks and rewards lie, but a terrible, terrible timing tool.
Yes.
So it's great, but obviously that can take 10 years to play out. So you complement that with the cycle. Where are we right now economically in different regions? And that tells you how much risk to take. Obviously going to recession, de-risk, recovery, re-risk. But it tells you also where to take that risk. So do you want to be in small caps if you're recovering, or do you want to be in high quality growth names if you're in a downturn? So that we spend probably most of our time there day to day. Like this conversation we just had is about where we are in the cycle.
Yeah.
That's very important. But it can be right over 6 to 12 months or even 18 months, but wrong over the next week. So the last one, liquidity, that's sort of a catch-all of monetary policy, financial conditions, fiscal policy is very important now, but also sentiment and positioning. So we talked about retail and their positioning in equities, like that tells you where the risks lie today. So if everyone's max long, valuations are stretched, but the cycle's fine, you might want to start to de-risk just because that's, 2 red, 1 green.
Yeah, okay. Yeah.
Especially if the cycle one is sort of flashing amber right now with jobs. So for us, we use that to make a decision. There's lots of information there, but then weighing up what's more important, the V, C, or the L, that's more of the art rather than science.
Yeah, okay. An experience thing.
It's an experience thing. Like right now, we mentioned, Grow, the ETF, but like because valuations are stretched in the US, again, we'll talk about bubbles potentially later, cycle we think is strong, but job markets are sort of cracking. So, green, but question mark. But everyone's all in and exuberance, we've been reducing risk.
Yeah.
Like not dramatically, but for us, we can sell equities and buy a call option, which is what we did in our fund. So if the equity market continues to rally or there is a bubble inflating, we'll participate even more so as the market rallies. But if the equity market falls short term because of these, the valuations and positioning, then our equity weight drops automatically as well. So some nice asymmetry built in there. So that's kind of how we take the view, this discussion we have to actionable portfolio outcomes that hopefully lead to better risk-adjusted returns for clients.
Yeah, makes sense. So you mentioned there that the US job market, the question is it cracking? And we don't know. And unfortunately, the shutdown has limited the amount of data we get. It feels like that's going to be one of the critical questions that determines how 2026 goes. Because from there goes US monetary policy, and from there goes a lot of asset valuation, a lot of asset markets. So if you can expand on what you're seeing in the US job market, but particularly into 2026, what are the key signals that you'll be watching?
Sure. So maybe I'll go the other way around, because I think about the job market, that's sort of the potential handbrake on our view.
Okay.
So before I get to that, let's just talk about why we think the economy is going to be strong next year, and then focus on jobs in the shorter term.
Yeah.
So GDP in the US is very strong right now. I mean, GDP is at 3.8, 3.9 in terms of the last prints and current nowcast expectations. That's really strong. So trend growth is like 1.8, call it 2%. So double trend growth right now. And it's all from consumption. So originally, the first prints, last GDP print was consumption's a bit weak. It was 1.2, got revised twice. Now it's 2.9. That's really strong. Anything above 2 is considered strong. So the economy is strong, consumption is strong. And the reason consumption is strong is because real wage growth is still positive in the US. So you get paid more above inflation, you're going to spend more or invest in assets. So that's still going on in the background. If you look at consumers' real disposable income, that's been steady for the last few years. And it's been very strong and steady for the last few years. And retail sales are now picking up again. So consumption is very strong. You only spend money if you have a job, though. So the question mark is, if you lose your job, all that positivity goes away.
Yeah.
So you have to look very closely at the job market, because that starts to crack in any meaningful way, that whole narrative gets taken out. So what are we seeing right now? Well, what caused most of the concerns was non-farm payrolls. That's how many new jobs are coming into the US economy every month. That fell dramatically compared to history. So let's say the last couple of years, anything, you expect to have 100,000 plus jobs, even more than that, 120,000 plus jobs every month. And that was what they call a replacement rate. So if you got that many jobs, the unemployment rate doesn't move.
Yeah.
It fell down to 20,000. So normally that means the unemployment rate rises, and normally you have strong jobs to weaker jobs to firings. That causes a recession. So the trend is very bad.
Yeah.
So why am I positive still? So good question. Maybe I'm wrong. Two things. One, if you're going to stop hiring ever, it would be Liberation Day onwards. Does that mean you're going to start firing people? Or does that mean, hang on, let's just wait and see where this goes, wait for more trade deals, then we can decide where to invest and if we need to keep hiring people. So if you're ever going to have a lull, now's the time. Unfortunately, like you say, government shut down, we expect it to pick up now, but we're not seeing the data. So waiting very closely to see if that recovery happens. If it doesn't, then we're wrong. We change our views, change our positioning. The other thing is that you no longer need 120,000 jobs per month to keep the unemployment rate steady. And the reason is, A, Trump kicked everyone out of the country.
Yeah.
He's got immigration controls, and also the population's getting older. So more people are retiring. They're retiring very wealthy because their house prices and portfolios are all-time highs. So participation rate's falling. So that means you don't need as many new jobs to come into the market to keep people employed. So according to the Dallas Fed, their own work, they said 30,000 jobs is the new break-even. Not 120,000, but 30,000. So we're getting around 50 to 60,000 for the next few months. The unemployment rate should come down. So in a way, it's scary to see the trend change, but we do feel like we're in sort of another regime shift here, where we've got this new policy coming in, limiting immigration. We had far too much under Biden. You can talk about legal or illegal, but you had 1 million people coming in. Now that's been reduced. So you need less jobs for them. What also keeps us sort of semi-positive is that the jobless claims, so when you get laid off, you apply for a jobless claim, that's been pretty steady. So we haven't seen it spike up. In fact, it's moving completely in average with this time of year for the last 5 years. So no sign of anything scary there. There's another thing called WARN notices, which you have to actually tell the state government if you're going to do mass redundancies or close a plant, you have to actually give notice to the government beforehand, 60 days beforehand. That's steady. ADP numbers came out recently. Again, looks like a bit of a recovery. They're actually paying workers more now, which falls into that same kind of category. If there's less people to do the work, then you're going to keep paying the good ones to stay.
Yeah.
Because you don't want to lose them like you did during COVID, for example. So there's a bit of labor hoarding going on as well. So for us, it's similar to 2002, where you had a jobless recovery. You saw GDP do really well, but there are no new jobs because the economy was reshuffling itself. So that's our current belief, is that jobs are fine. Yes, weaker than expected. Yes, you're seeing the new job numbers fall, but you're not seeing layoffs en masse yet.
Yeah.
So we're still waiting to see. Again, very important to watch, because obviously if that deteriorates further, we're wrong, and then sell everything. but for now, we think the economy's strong, jobs are fine, just a bit of wobble, and the Fed's cutting rates to defend that if it is a problem.
Yeah.
So all in all, we think it's a good balance and it's going to recover in the next coming months.
Yeah, that's interesting. I mean, you said earlier that so much of the above trend GDP growth is driven by consumption. Do you worry that the lower population growth and lower job ads will start to challenge that growing consumption narrative?
So yes, I mean, one part is unemployment stays low, but there's less people consuming. So the aggregate is less demand. That is a concern. But, and again, it's the US economy is going through this K-shaped recovery. So if you ever hear about that, it means because the really wealthy are doing well and the poor aren't doing well. So it's that K-shaped rebound. The top 10% of earners are 50% of consumption. So
that is unbelievable.
It's unbelievable, right?
Yeah.
And again, I don't want to sound callous or generalize, but the people who immigration have stopped coming in a dollar term don't spend as much as, say, someone working at Tesla, for example.
Sorry, just 50% of consumption is driven by the top 10 income earners, top 10% of income earners. How does that compare to like historical norms?
Honestly, I don't know.
Okay.
But I'm assuming it's quite high.
Yeah.
It seems very high.
Yeah.
We can get back to you on that one. But for us, it's kind of an interesting dilemma, because the question now is, does the economy lead the stock market, or will the stock market lead the economy?
Yeah.
Because if the market tanks, then suddenly the wealth effect for that top 10%, I mean, it's probably still fine, but you might spend less if suddenly you're down 30%, hypothetically, right?
Yeah.
So it's a bit of a weird dynamic to be in. So you need a strong economy, but maybe you need a strong equity market to defend the consumption.
Yeah, that is interesting. So let's flip the conversation. We've been speaking about things that are really going to matter. Mm-hmm. I want to get your view on things that maybe don't matter, things that you hear discussed in the financial press, or just around the traps, indicators, or certain ways of thinking about the world that you think are overhyped or maybe just leading to the wrong conclusions.
That's a tough one, because I think everything tells you something. Even if it's wrong, it tells you something. For us now, I'd say the job numbers are what we think is probably being too much looked at. Obviously, if it gets worse, we're wrong.
Job numbers being too much looked at. Didn't we just speak about job numbers?
But like recently, there's a Challenger report that came out. It's a US company, not Challenger here.
Yep.
That came out very, very weak. So of course, everyone's like, look there's the proof. It's terrible. No one's ever cared about that report until now, because there's nothing else coming out. And suddenly it's like, the golden goose that's telling you all the information you need to know. It's like, no, it's a pretty terrible report. That's why it's never really used. And there are indications of lots of those data prints that come out that if you've never heard of it or never been used before, it's probably not the time to start using it. But it's an interesting question, because like we've had debates in the past, like for example, 2023, the recession that never came. Everyone's looking at the yield curve saying it's inverted, therefore recession. And that was a period of time where we were in that camp as well for a while, but we came out of it faster than others, because we realized, well, that's just telling you that monetary policy is tight. It's not saying it's definitely going to be a recession. It just means monetary policy is tight. So we have a recession indicator that has 20 indicators.
Okay.
So that's when you kind of go, okay, one by itself might not be enough. So to answer your question, I don't think there's one thing that's, leading investors astray, but don't just focus on one thing.
Yeah.
Right? Because if I'm saying everything else is positive but one thing's negative, then you really have to wait. What is that one thing that's leading you awry?
So we've spoken a lot about the US so far. Let's go to the rest of the world. You mentioned the global catch-up, and it may not be that the rest of the world actually catches up to a red-hot US, but it might just be that their rate of change improves. What gives you confidence that the rest of the world is going to, accelerate? Sure.
Well, I guess that first point's important, right? The US is running red hot and the rest of the world's going from weak. I think last time we talked about stumbling out of a slowdown. So they're getting back up to trend growth. Not above trend growth, but just back to normal. And that rate of change is important. So you break it down and we say ex-US or the rest of the world, but of course, it's different regions, different outlooks. But I guess the largest one outside the US would be Europe. It's been more sluggish than many have expected. We think it's going to do well next year and continue to do well for the next couple of years. A few reasons why. I mean, the most basic one from an equity standpoint is people are actually starting to say US is too expensive, starting to reallocate back to Europe. And that rate of change can mean a lot for a smaller equity market, from a big one to a small one. But if you think about the economy for a second, ECB have cut rates a lot. So that takes time to come through the economy. Of course, they hike rates a lot, now they cut rates a lot, but that rate of change should be very positive. The second thing that's important is that we're now seeing fiscal stimulus come back again. So you've had fiscal austerity in Europe since 2011. You might recall the pigs, Portugal, Italy, Ireland, Greece, Spain. The whole conversation about them blowing up, Greece defaulted. All that stuff caused Europe to be fiscally conservative for a decade and a half, right? Now, because of Ukraine and other things, they're actually now spending quite a bit of fiscal stimulus. So Germany is spending an extra 3.5% extra fiscal stimulus per annum, and that's on defense. Now, defense is a loose term. They can't spend that much money today on their own tanks and missiles and everything else. So what they're doing is effectively normal fiscal stimulus. They're increasing the pay for soldiers because what else can they do? Pay them more money. That's fiscal impulse. They're building more barracks to potentially put more soldiers in that don't exist yet. That's just real estate investment.
Yeah, okay.
They're improving the roads or infrastructure because what's the point of having a tank if you can't drive it to the border? So they're calling it defense, but ultimately the current spend is mostly just fiscal stimulus. That comes in, it hasn't come in yet, so it's a little bit now. That comes in halfway next year, and then full hog 2027 onwards for a couple of years. So it's a massive ramp up in fiscal stimulus in Europe. At the same time, in Germany, to generalize, Europe in general has a very high savings rate. So unlike the US, where you max out your debt and go well beyond your skis, so to speak, Europe's the opposite. In Germany, they like to buy houses with cash and save up for that. So there's lots of cash on the sidelines. If animal spirits ignite, that money can come into the economy and again boost it up. So rate cuts, fiscal, potential spending. Within that, though, it's interesting because talked about the pigs. The pigs are flying right now.
Yeah. Southern Europe's doing well. Northern
really
Europe's
well.
the challenge.
Exactly. And they did this crazy thing where during COVID, they said, rates are zero or negative. I'll just borrow lots of money then. And that actually made the economy grow now. So even though their debt increased, their debt to GDP is improving every day. Whereas Germany and France, who didn't spend during COVID, are struggling.
Yeah.
So economically speaking, Spain and Italy, they're doing really well. Equity-wise, the market's still very cheap, even today. And their earnings are well above Germany and France. So I like economic growth with cheap valuations and improving EPS growth. So I think Europe's fine, it's going to recover, and we like the periphery over the core. Then you go to emerging markets, again, a big catch-all there. It's lazy to say, but in general, weaker US dollar, US cutting rates, good for EM. We talked about inflation falling in EM, where it's not really falling in DM. Food price inflation is important in emerging markets. That's coming off. Usually, central banks in EM have to keep their interest rates high to defend their currency against a strong US dollar. Now that's weakened and inflation's weakened, they can cut rates to defend their economy. So we do think, in general, EM economy should do well.
EM being such a broad term, encompassing everything from China, Taiwan, and South Korea to Africa, South America, and everything in between.
Yeah.
Any particular pockets of EM that you find particularly interesting?
Sure, I'll go through the main one, China.
Yep.
And then I'll go through the one we like.
Okay, nice. Yeah.
We like both. But China, again, we're talking about rate of change here. So the economy has gone from extremely bad to less bad. Still bad, but less bad.
Yeah.
So it's a positive rate of change. They're going through a balance sheet recession. We talked about it last time I was on, but you can cut rates as much as you want. That's just going to make it less painful to restructure, but it's not going to stimulate demand. So banks are saying our interest rates have fallen. We can lend money now, but no one's there to borrow off them. So you need to improve demand through fiscal stimulus. They're not doing that yet. So for us, the economy in China remains weak, and that reason why we don't like equities broadly, because we need the economy to recover to justify the current rally outside of tech. So tech's been doing really well in China, like the QEB ETF, whatever you want to call it, the China tech giants, like they're doing well because value's been unlocked. Like when we last spoke, China was uninvestable. Now it's like the hottest thing.
Yeah.
So views can change. And the reasons views change there is because Xi Jinping shook hands with Jack Ma. That whole saga was over. He said there's now an equal playing field between public and private companies. It's a huge change. So those tech companies are re-rated. Those tech companies are doing just as well, if not better, in the AI race. There was even news coming out like last week. There was DeepSeek a while ago. There's a new one recently. I think it's 25% chips are required. So 75% reduction in chips required. So again, a bit of a knock on NVIDIA and others. But they're also spending in AI. So that's CapEx supercycle story is also happening in China. So we like China tech in general, but the economy's, it's a trade, not a strategic asset allocation, because the rest of the economy has to catch up through fiscal.
Yeah, okay.
What we do like, which might be a bit spicy, but Latin America is still very cheap. Very cheap compared to Asia and EMEA, so Asia, Africa, Middle East, and Europe, but cheaper than its own history as well.
Yeah,
so it's cheap within the index and within the regions, but compared to its own cheap valuation, it's cheaper than that. There are very few markets out there that I could say are cheap right now, but Latin America is one of them. Obviously full of issues. Lots of government corruption, lots of central bank independence being eroded. Sounds like America right now. But it's cheap. And they can potentially cutting rates to defend the economy. So we do like Latin America because of the valuations and the improving earnings and the fact that, if anything, they're moving away from where potentially the US is heading in terms of government intervention, so to speak.
Well, we've done a tour of the world. I want to now move to some themes. And
Sure.
I said we'd put a pin in the AI bubble question. Let's unpin that, because I think that's the big question for most investors going into 2026. And to the point of you can pick either side of an issue and find data points to back that up. I think that is very true when it comes to this AI conversation. Every day I open Twitter and I'm assaulted by arguments either way. So I want to get your view. AI, is it a bubble? Are we in the early innings of a bubble, or is it, justified growth based on fundamentals, or where do you see this story?
So to cop out, first of all, we asked 4 AIs for their own view. Yes or no, are we in a bubble? All 4 AIs said yes.
That's interesting.
So, maybe they're right or they're wrong and they're not going to take our job anytime soon. So that also invalidates and makes it true that it's in a bubble. But for us, I mean, the for and against in the sort of top-down macro view is that why people think we're in a bubble: valuations are stretched, concentration is very high. The circle of financing thing is a concern.
Yeah.
So you think, the hyperscalers buy the chips off NVIDIA, who buy it off TSMC, who then lease them out to like CoreWeave, who then have an Oracle deal and it comes back again. Yeah. So that is a bit of a concern. Also, there's the fear of missing out, the media hype and everything else. Yeah. So that's in the yes bubble camp. In the no bubble camp, these companies, well, at least the hyperscalers, they are very profitable companies. The back book of business is delivering fantastic earnings and free cash flow. So it's not like they have nothing else going. It's not pets.com. Microsoft is Microsoft.
Yeah.
So it's not this unprofitable tech rally in the mega cap space. Another thing we said why it's not a bubble is leverage hasn't entered the game. Unfortunately, it has started to enter the game. So if you think about the new Oracle deal or the Meta deal, it's quite a lot of money coming into it. It doesn't sound like big numbers. I think Meta was $30 billion. But if you go for the past 10 years or so, the amount of debt issuance from tech companies in the US has been around 20 to 30 billion every single year. This year to date is 120 billion. So 4 times the average. That's a big step up. Now, if you're paying for AI through free cash flow and it turns out to be a non-event, you just wasted money, but your back book is still positive. If you're using leverage and it turns out to be nothing, you default. So for us, the more leverage that comes in the system, the more worrying it is. This is the start of the worrying phase. If this continues, I'd say we're now in bubble territory, but we're at the start of the danger phase, not the end of it. So we are starting to get concerns. But again, it's case-by-case basis. So CoreWeave is a public company. Do I think that has good earnings per share? I have no idea, right? But the mega cap hyperscalers we think are quite good companies. And there's winners and losers. So be selective in your stock picking there. It's all these other smaller companies that you never heard of that are starting to pop up that are trading on crazy PE multiples. That's probably a bubble already. And, some will win, some will lose. It's a bit of speculation going there. But for now, I'd encourage you and your listeners to listen to the interview you had with our PM, Frank Thorman. He's more I'll pick the best of the tech companies in that.
Yeah.
And he runs an ETF called ALF, ALPH. That's his job. His job is to pick the best winners and losers. So I know he's overweight some of the Mag 7, underweight the other half of them.
Yeah.
So I'll let him do that.
Yeah.
But for us, we do think that it's a different story because it's profitable tech doing well. So ignore the unprofitable tech. That is probably a bubble.
Yeah.
The mega caps are starting bubble phase with the debt. If that continues to accelerate, you got a problem. But that's not a tomorrow issue. That's like a few years down the road issue.
Yeah. And I guess it depends like how much debt as well.
Exactly.
Because like right now, the debt is very manageable and serviceable within their extreme profitability.
Correct. So starting to raise alarm bells, but I'm not saying it's going to crack tomorrow.
Yeah, okay, nice. So we'll be watching that AI theme pretty closely, obviously. Another theme that really stuck its head up in 2025 in a pretty amazing way, and it's come off a little bit since, but gold. it was acting more like an AI growth stock than a precious metal store of value. Where does gold go in 2026?
Good question. So we've been bullish on gold for a while now. And the reason we're bullish is back to the original part of this conversation, last conversation, higher inflation, loss of central bank independence, fiscal stimulus. That's normally when gold does well. Say it's an inflation hedge is a bit of a cop-out because it's not always an inflation hedge, but it's a hedge against currency debasement and a hedge against, again, fiscal largesse and central bank losing independence. So that's kind of, again, more ticks in that camp this year than before. So we do like gold. If you think equity bond correlations, which they are now positive, is going to mean that a 60-40 portfolio is less likely to, the bonds are less likely to protect your equities if they're moving in tandem, you want to find other hedges. So gold fits the bill. So we've liked gold. We've allocated to gold and grow. We've had gold miners as well in the portfolio. They've done really, really well. So we topped up gold after Powell came out dovish at the Jackson Hole conference, and we sold it at the beginning of October because positioning just went crazy.
Yeah.
Queues outside Martin Place trying to buy.
No, it was nuts.
They've all gone now, so that's good. So for us, structurally, we like gold for those reasons. Inflation hedge, currency debasement, trying to find something to defend your equities. The positive structural story is that emerging market is another catch-all, but central banks that aren't the West, they've been buying lots and lots of gold because their gold as a percentage of their reserves has been rising, but it's only like 13, 14% of reserves right now. The developed world's more like 45% of reserves. And EM central banks have told everyone they're trying to play catch-up. So there's a lot of buying for them to do if they want to get even close to the developed world in terms of percentage of reserves. Not dollar amounts, because obviously weaker economies can't buy as much, but just a percent of reserves. So that's going to be a buy opportunity for the next couple of decades.
Okay.
But to say they're price insensitive is not true. Like, they're never going to slam the brake on. They're going to buy lots when it's cheap and take the foot off the acceleration when it's expensive, but they're sort of always there trying to buy. What started recently was the retail or investor sentiment uplift in the developed world. So September saw the largest inflow to gold ETFs ever, and I think it was 2 or 3 times more than the second largest inflow ever, which was 2020. So at that point, you had speculative blow off top. You saw things go crazy in October. September was great, but October was even more insane. So we started to de-risk on that, and we sold about 30% of both our gold and gold miner exposure. We're starting to buy that back because now it's basing it around 4,000. That's healthy. If it kept going, that's a speculative blow off top, and you want to avoid that. But now it's basing around 4,000. We think it's setting a base for next year to accelerate again.
Okay.
So we do like gold in portfolios for next year. But you got to be tactical of when you get in and out, given some of these blow-off tops can be concerning.
Yeah. So you work on the Schroders Real Return Active ETF, GROW. You mentioned that ticker earlier, which is a multi-asset portfolio. And so I want to ask about portfolio construction when it comes to gold. How do you think about gold fitting in a portfolio like that? Because I'd love to think about how it can fit in my personal portfolio.
Sure. Well, for us, it always depends on how much risk do you want to take in your risk section. So let's think equities. Then do I need to hedge that? And if so, what range of hedges do I have? So if you've only got one, you'll have more allocation to that one. So I'm not saying gold's the only place in town. So you do want to have some government bonds in there. You want to have some foreign currencies. In the past, you'd use US dollars as a hedge against your equities because Aussie typically falls in a risk-off environment and US dollar rallies. That doesn't seem to work anymore. So it's more about getting euros or Swiss franc or yen. So there's currency you can use. You can use options to hedge. You can use gold to hedge. You can use bonds to hedge. There's a whole plethora of things you can do, or just buy less equities.
Yeah, okay.
So that's a real big cop-out. But the way we're doing it is trying to get what is the risks right first? How much equities do I want? Then how much gold do I want to have as a hedge? So for us in our portfolio, we only had 3% in gold and 3% in gold miners. But when gold miners go up 150% in a year, that's a pretty sizable allocation. But we've been dialing the gold and commodity allocation up at different points of the cycle because commodities are also a hedge in an inflationary world. Yeah. So it's about getting those things right. But to answer your question, like right now, most investors have 0 to 1 to 2% in gold, whereas historically speaking, 10 to 20 was normal.
Wow, 10 to 20.
That's back in the inflationary
That's higher
days,
than I expected.
Right?
Yeah, okay, yeah.
You listen to Ray Dalio, he's got like a quarter in gold.
Yeah,
right?
I know.
So
His all-weather portfolio.
It's all-weather portfolio. So there's
yeah.
some gold bugs out there say you just have 100%.
Yeah.
That's not what I'm saying. But it depends on how much risk you need to take, right? If you have a 60-40, maybe some of that 40 should be in gold.
Yeah.
If you go to 90-10, then it doesn't really matter because equity is going to drive your portfolio either way.
Yeah, it still matters.
Yeah.
Yeah.
So I think it does have a part in there. But yeah, we've been dialing up between 0 and 5%, but also gold miners as well.
Yeah. Okay. So I want to bring, all this conversation together and close it out, because I guess, we've covered a view of the world, a view of some major themes, and particularly a conversation around the US, because we know how important that is to global markets. How do you bring all of that together into like a coherent asset allocation and portfolio construction decision for the funds that you work with?
So you're right to that process I mentioned, that VCL process, value cycle liquidity. That helps us decide, again, how much risk to take and what we need to hedge against it. So for us, we're updating those, pretty much daily, but say officially every few weeks or every week and every month we have a full deep dive into make sure we're not offside. But every day we're looking at these things. So for us, it's about, again, back to the gold question, first of all, how much risk do you want to take in equities? What do you want to have as your main driver of returns? Within that, do you want US? Do you want to buy the pigs or emerging markets? Like that's what spends most of our time deciding what kind of risk do we want to take. If we think things are going to go gangbusters next year and valuations, if they were cheap, for example, we just want to have more equities. Another part I didn't mention is our expected returns and probability of loss. Now, it gets quite academic, but effectively that tells you where's the best risk-adjusted returns to take and which assets to avoid if you think they're going to lose you money next year. So that combined with the VCL process, and obviously we have 12 people in Australia doing this job every day. So our debates, our discussions help dictate where the portfolio goes. But Grow has an interesting dynamic that's get returns. So Aussie CPI 4 to 5%, but also minimize drawdown, minimize volatility. So we're always trying to, there's a bit of tension there between getting your returns, but also getting out of risk when things are going awry. So we right now try and triangulate that all together, but we're pretty bullish for next year. But given the current positioning, as I mentioned, we sort of raised a bit of cash, sold some equities and bought some call options. So we can stay in if the market keeps going higher, but if the market does have a short-term washout, we can reallocate and buy the dip. So I'd say we're de-risking because we think it's a short-term wobble, but we're looking to buy the dip because we are quite positive next year.
Nice. Well, Seb, we have come to the end of our time. I guess as a closing question, is there any final thought you'd like to leave our audience with? So I guess we can maximize our returns for 2026.
Well, again, it's hard to say because all the data is being frozen right now.
Yeah,
so
okay.
It could change tomorrow. So for us, I am in the middle of writing my outlook for 2026. Haven't written it yet, so
waiting for that data to come through.
Yeah, exactly. But they will be coming out on our website about a week after this is released. So it won't just be my outlook, but all of the Schroders, my Schroders colleagues, will be on the Schroders website. So you want to go there in a week's time. You'll see not just me, but equities, credit, fixed income, a whole host of people will be giving their 2026 outlook. So listen to those, watch those, get in more insight than just little old me. But I think from my view mainly is we do think the economy is going to be run hot. You think about all that debt I mentioned before, government spending, there's only one way to get rid of that debt, and it's to inflate it away through higher growth and higher inflation. So I don't think there's any appetite for governments to go into a recession. And Trump will pay you $2,000 now for a tariff distribution. I'm sure he'll claim there's a national crisis in housing to stimulate the economy. He'll do whatever it takes to stay in power. So for us, we think economy is globally going to spend more money. Inflation is going to be higher, but growth will be higher too. As long as that's, say, 6% nominal growth, say 3% inflation, 3% growth, that's fantastic for equities.
Okay.
If inflation's higher than that, that's when you have a 2022 sell-off.
Yeah.
So for us, it's riding that fine line between taking the risk and getting those returns as inflation erodes everything else, but being ready to de-risk when you start to get too far over your skis. So long story short, be dynamic, keep a pulse on the market, follow Trump on Twitter or Truth Social or X, whatever it's called these days, because there's going to be a lot more volatility than we've seen over the last 15 years. So get used to it, strap yourself in, but ultimately navigating those volatility events can be quite profitable if you're doing it right.
Sounds like we're going to strap in and ride the roller coaster for 2026.
Exactly. Strap yourself in. It's going to be fun.
Well, Seb, I look forward to riding this roller coaster with you. Look forward to getting you back on the show. But until then, thank you for joining us and sharing your insights.
Great. Thanks, Ren. Thanks for having me.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.